Then that is now the work of technical analysis. So, Mr. Mark, welcome. Okay, so for today we will be looking for. Sorry, for today we are going to look at the last part of this chapter one, and that is going to be about a few terms which are being used in forex trading. We have a few terms there, so that is now what we are going to be looking at. And as you can see on my screen, I don't know whether, let me confirm, I've not shared my screen, so allow me to share my screen. Allow me to share my screen. All right, so we can continue. So as you can see from my on my screen, we have some terms here like spreads, PIP, leverage, margin. So we are going to check on this and get to know what are these, what are these, what are these. So the first one, spreads, spreads. This is the difference between the buy and the sell price, or the bid and the ask price. So in this case, you have known bid is buy, ask is sell, right? So every time you go and place a trade, your trade is in most cases your trades are going to begin with a negative. If let's say the spreads are something like negative are something like 15, so your trade is going to start with a negative 0.15 or something there around. And through spreads, this is one of the ways brokers make money. So when you're choosing a broker, choose a broker with the lowest spread as possible, because there's a broker you'll get that they have spreads of something like 10 and the other one has spreads of 50. That is let's say you're trading gold, so the broker with the spreads of 50, it's making more money from you compared to the one with the spreads of 10. So if you and I place trades with these two brokers, the first one will start with negative $0.12, the other one will start with negative $0.5. So you can see we have a difference of $0.4. That's a lot. Imagine now we have something like a million people trading with broker B, which has 50 pips. So $0.4 times 1 million. You can see how much the broker will have made if you just do some simple calculations. So I believe now you have been in a position to understand what are spreads. So when you go to your meta traders, because last week I showed you how to use the meta traders. When you go to meta trader, when you just check on any pair, let's say it's something like GBP USD, just below the USD, you're going to see something like 8, 9, 10. The number keeps changing. That is not the difference. You can as well take the buy price, that is the one on your right hand side, you subtract the sell price, the one on your left hand side, and you are going to get the same number as the one which is appearing on your screen. Now let's continue. Let's check on another term, pip. Pip. A pip stands for percentage in point. So what is a pip? A pip is now the we can say a pip is like the SI unit for in forex, right? But in simple terms, you have said a pip stands for percentage in point. When they are many, we call them pips. So a pip is one. When they are many, we call them pips. And from the simple explanation I have here is that a pip is the smallest unit or movement in an exchange rate. So if the market is going to move from something like 2020 to 2025, that is now the difference between 2020 to 2025. That is going to be now the number of pips the market has moved. That is now the the um, the change, right, in that exchange rate or currency. And another point there is that it measures the amount of change in an exchange rate for a currency pair. That is now the work of a pip, right? Now we say that It is the fourth number after a decimal point, except for Japanese yen pairs, where it is the second unit after the decimal point. So I can just come here and have something to look with you. So like in this case, you can see currently the gold price is at 3301.82, but for gold it's different. So let's check on something like GBP USD, which is now the normal one for currencies, where we have said it is the fourth what? It is the fourth number after the decimal point. Like in this case, the current market price for GBP USD is 1.35084. So from the decimal point we have 3508. So if you are just to say casually, the number of pips in this case you are going to say it's 8 pips. Now if the market is going to move from the current market price, that is 1.35084, to something like 1.35200, for you to get now the difference or the number of pips or the movement that pair has done, you will now take the 1.35200, which is here, you subtract where you entered the market, which is now 1.35084. But for that we will check when it comes to how to calculate the pips. I was just showing you now an explanation of that point. It is the fourth number after the decimal point. Now for Japanese yen GBP JPY, we have said for JPY it's now the second. It's the second number after the decimal point. And you can see on Japanese yen pairs what we have. Like in this case, we have the price at 194.9942. So our focus is on the first two letters or numbers after for the first two numbers, the first two numbers after the decimal point. So in this case, you are going to say, if someone is to ask you what is the pip value in this case, you are going to say it's now what? It's 4, which is the second number after the decimal point. So yeah, I believe on that I'm clear, so we can continue. Again, let's check on another term, which is leverage. Leverage. And what is leverage? Leverage, this is the ability to trade positions bigger than your account balance. And in this case, I've just tried to explain there. Being on leverage is like taking a loan from a broker, right? Leverage. And leverage applies in very many aspects in our lives. So for this thing about leverage, I'll give you an assignment. Go and do more research on leverage so that you can get a deep understanding of leverage on your own. I might explain to you about leverage, but you will not understand it better compared to if you do your own research. Leverage, you need to understand it better, because if you are to shift in future and do crypto trading, that is futures, you will use leverage in it. So like in this case, as I've just said there, being on leverage is like taking a loan from the broker. So giving you an example here, you have an account that is worthy $100, right? You can be able to trade trades which are worthy $10,000. That is now 100 times more than your account balance. With what kind of a leverage? 1:100. That means you are able to trade trades worth 100 times your account balance. So if your account balance is $10 and you are using the leverage of 1:200, that means you are in a position to place trades worth $2,000, which is now 100 times more than your account balance. So for that one on leverage, I'll leave an assignment to you. Go and do more and more research on that so that you may understand it much better for your understanding. Let me go to the next point, that is swap. What is swap? Swap This is the interest you as a trader pay for trades that you leave to run
Okay.
overnight. So if you place your trades
Can I
and
ask?
yes, please.
On I'm concerned about the leverage.
Yeah,
So you said if I choose a leverage of 1:200.
yeah.
So if I have a $10 account on my broker, can it hold a trade of up to negative 200?
That is not what it means, eh? Okay, what it means, let's say you have an account of $10, right? And you are using leverage of 1:100. So it will come to a point. Let's say you have taken some trades and your account balance is now at around $5-7. There are assets which you will not be able to trade, something like, let's say, gold. But if you are to go and adjust your leverage to something like 1:500, you'll be now able to place that trade and it's going to execute. But using the leverage of 1:100, it's going to tell you don't have enough capital, you don't have enough money, sorry. But if you shift and trade something like Audi USD, the trade is going to execute. So I'll do more on leverage. I'll do more on leverage so that at least you guys can get to understand that much better. So first do some research. The reason as to why I've said you do research, because I know leverage, it's one of the challenging subtopics for one to understand. That's why I've said you first do your own research about it. What I've just done is now the, what can I call it? It's just like the cover, a definition, right? Yeah. So I hope now you can get me and get my point there, right? I'll check tomorrow and give some recommendations on some of the materials you can use to understand leverage better. Yeah. So we can continue. I was talking about swap. Swap, I said this is now the money you pay for trades that runs overnight. So if you had placed, let's say you had placed trades in the morning, or we have placed some trades right now, and they are going to run overnight. And let's say in the morning you have a profit of something like $50, and the swap is something like $3. So if you're going to close the trades, your profit will be $47 but not 50. So $3 will have gone to the broker as what? As swap fee. I hope you can understand that. Um, we have something we call margin. Margin. Margin now, this is the amount of money that a trader needs to put forward in order to open a trade. Simply, this means this is the minimum amount for you need to have in your account for you to place a particular trade, and it varies with whatever you are trading. You can get that if you are trading GBP USD, you need maybe a minimum of $1, $2 for you to be able to execute one trade of that pair. If you are trading something like gold, you can get that you need to have a minimum of something like $3 in your account for the trade to be able to execute, right? So vile nimesema kwa ufupi, margin ni ile pesa unatakikana kuwa nayo kwa account ndiposa uweze kuwekelea hiyo trade na ikubali. So if the margin is something like 1.5, if your account balance is below 1.5, if you execute the trade, it's going to tell you not enough money, right? Yeah. And there's another point there. When trading forex on a margin, you only need to pay a percentage of the full value of the position to open. So like kuna watu pia wameanza kujiuliza maswali like, I have an account of $100. If I place a trade, is it going to consume all my $100? No. That is now where the concept of leverage comes in. It's going to have just a percentage, a portion of that. If it's let's say if the margin is $3, the trade you're going to execute is going to consume only $3. The rest will now depend with if is the trade going on your side or against you. So if you have placed a buy and the trade goes on your side, you're good to go. But now if it goes against you now, it will now you are going now to start making what? The losses. Now let's check on the other one, that is now free margin. Free margin. Free margin. What is free margin? Free margin, this is the amount of money in a trading account that is available to be used to open new positions, right? Free margin. So when you go to your MetaTraders, as I showed you, and you click on the section for trade, you are going to see we have balance, equity, we have margin, then we have free margin, right? So you go and just observe this. If you have running trades and they are in profits, the free margin is going to be high. What does that mean? Like free margin, this is now the available money which can be used to open other new positions. That is how it is simply means. That's simply what it means. Sorry, that's what simply it means. Free margin, the amount of money that is available to open new positions, right? And it is calculated by subtracting the used margin from the account equity. So once you do those calculations, you're going to see everything is going to reflect there, right? The other one is equity. Equity. What is equity? Equity, this is now the total value of a forex trader's account. This is now the total value when you have those running trades or active positions. So if your positions or trades are in profit, equity is equals to account balance plus the running trades profits. That means if you're going to close those running trades right now, that is now going to be your new account balance. And if your trades are in a loss, you are going to have your account balance minus now the losses. That means if you are going to close that running trades immediately, the equity is now going to be your new balance. Let's check on the last one here is what we call a margin call. A margin call, this is a notification which lets you know that you need to deposit more money in your trading account or close losing positions. In order to free up more margin, it's denoted as fixed percentage, which is determined by your broker and can be seen in the account specifications of your trading account. When you go and read those terms and conditions to some brokers, you're going to see that when your account goes below, let's say something like 60%, the broker is going to notify you through what we call a margin call. We have one very useless broker by the name of Expressa. They normally make calls to you telling you deposit more, but never do that kind of shit. If you're in a trade and the trade is against you, don't go and start adding more money on that. Just let it end, and then maybe you come the next day and deposit, because this trade is against you and the trend might be very strong on while it's still against you. You deposit, you lose. In this case, you will have lost now twice. The first deposit, the one you have added, and in the following day maybe you might lack some capital to deposit in your account. So but about these or those, we are going to check them when it comes to risk management. And so we have something we call a lot size. Lot size. What is a lot? A lot is a unit measuring a transaction amount in forex. It's like let me just give you a good example. You are going to the shop and you need to purchase sugar, right? You have to state the the quantity. Is it a quarter? Is it a half? Is it 1 kg? Is it 2 kgs? Is it 3 kgs? Is it 5? Right? So the same thing happens in the forex market. When you are placing those orders, their values are now in the lot sizes. We have types of lot sizes here, and as you can see, the first one is what we call a standard lot. And a standard lot is the lot size, any lot size above 1, from 1 all the way even to 10,000. If you get a broker accepting that and you have a good account which can be able to place the trades, well and good. So a standard lot is any lot size above 1. Then what we are going to focus most is now the lot value, not a number of the units is not that much important. We are going to focus on the lot value. So if you are trading a standard lot, its value is going to be $10. That means if you have placed a trade with a lot size of 1 and the market goes on your side, one move or one pip, you will make $10. If it goes on your side 10 pips, it's going out to be $10, which is the lot value, times the number of pips. So you will have gained $100 in that trade. Same applies if the market is against you. If it's 10 pips, you are going to be losing what? $100, right? We have the second one, which is mini lot. And a mini lot is the range of a lot size from 0.1 to 0.99, right? 0.1 to 0.99. What does that mean? Each and every move is equivalent to $1. If it's on your side, you gain $1. If it's against you, you lose $1. I believe you have gotten that. And then the last one is what we call a micro lot. Micro lot is the least lot size, and also this is the most advisable lot size for you beginners to use. And it's a 0.01 to 0.09. That is now the micro lot, and it's equivalent to $0.1. So if you're using the 0.01 lot and the market goes on your side 100 times, that is 100 pips, you are going to have now the lot value, which is 0.1 times the number of pips, and you are going to get that in that trade you will make a profit of $10, right? Yeah. And as I've just indicated here, some brokers you show quantity in lot sizes, while others show you the actual currency units. But most of the brokers currently are doing it with the quantity in lots. If it's 1, 2, 0.5, yeah. So we have some examples here. Let's check on the first one. 0.01. This is a micro lot, right? This means that if you place a trade with the 0.01 lot and the trade goes on your side, 1 pp you will earn what? $0.1. If it's against you, you're going to lose $0.1. If it's 0.02 lots, that is now equivalent to $0.2. In this case, we are looking for the total number of what? The total, not the total number, but the total value of the lot value. How many lots have we used here? 0.02. So if 0.01 is equivalent to $0.1, what about 0.02 lots? What the value? It's equivalent to now to 0.0202. And then once you have now the lot value, or the total lot value, you can now multiply it with the number of pips you are targeting. Let's say you have entered the trade and you target only 10 pips. So in this case, that trade you will exit, or you are going to close with only $2 as your profit. Or if you have decided your loss is going to be something like 30 pips, is now going to be 0.02 times 30. You will close the trade with a loss of $6, right? Yeah. Another example there, you can see it. If you have used a lot size of 0.08, that is now equivalent to $0.8. You just first find the total lot value. First, you have to find the total lot value. This means if you are trading with 0.01 lot, you first need to calculate the total number of lots based on the number of open positions. E.g., if you are opening 3 positions with 0.01 lot, 2 positions with 0.02 lots, and 5 positions with the 0. What? And 5 positions with 0.08 lots. First, you calculate what? Each and every positions based on the lot size you have used. You do those calculations, and then once you have known first the total number of lots, you look for now the total value, the lot value, the lot size value, the lot size value. Once you have calculated that, you can now uh, look or calculate now the profit and losses. And in this case, you can see the total number of lots used is equals to number of positions times the lot size you have used. So let's say you have opened 5 positions with a lot size of 0.01. So how are we going to know the total number of lots? Is equals to how many positions do we have? We have 5 positions. Multiply by the lot size, which is now the 0.01. So our total lot size used in this case is going to be 0.05. And if it's 0.05, if we are to look for the lot value now, we will have if 0.01 is equivalent to $0.1. What about 0.05 lots? That's going to be equivalent to $0.5. That means the whole the total lot value for the 5 positions is 0.5. If the market moves in our side 1 pip, we make a profit of $0.5. If it goes against us, we lose the same amount. Now, we have how to calculate profits and loss in forex. How to calculate profit and loss. What is risk? Risk, this refers to how much you can lose in a trade. That is the risk. And in this case, how do you get a risk? Risk is equals to the stop loss minus your entry. Entry is where you have entered the trade. Stop loss is where if the market goes against you, you say the number of the amount of loss I would have incurred up to this point is enough. I can cut the losses. That is now risk. What about reward? Reward, this refers to how much you can make or earn in a trade. Right? And reward is equals now to take profit, you subtract your entry. Where you entered the trade minus, where you are targeting minus where you entered the trade for you to get to know now uh, the number of pips, or you get to know it in terms of dollars. So for these ones, it's not that much. What is more important first is to know how to calculate. Okay, it's not here yet. So tomorrow I'm going to do a video. I'll record a video for that. How to calculate the number of pips. How to calculate the number of pips so that you can be in a good position now to calculate profit and loss. So calculating profit and loss is profit stock loss is equals to the total number of pips times the total pip value. I've just told you how you can calculate the total pip value. You take the number of positions times the number of what? Oh, sorry. The total number of positions times the lot value you have used. Once you have the total lot value. Sorry, once you have the total number of lots, you can now multiply it with the total with the lot value. So tomorrow I'll do a video on that. I'll do a video explaining that and upload it there. Now tomorrow is on Wednesday. We will have a class as well. We will now start what we call the technical analysis, and in technical analysis, this is the most important part where we are now entering. This is now the chart work. You have to pay more attention to this and make sure you attend all those classes, because through this now you will be able to understand how to read the charts, make your decisions whether buy or sell, know when not to trade, how the market conditions, all those things comes, when to enter and exit the market. All these things comes in this chapter 2, technical analysis. So in technical analysis is when you will know how you can analyze these kinds of charts and decide, am I going to buy or am I going to sell? Yeah, so all this comes in technical analysis. So make sure you pay attention on that when the time comes. Yeah, so Andrew, I can see your hand is up. You can unmute your mic and maybe ask your question. So for technical analysis, it's what you use to do these kinds of things. You first do analysis, then you show your expectations. Like in this case, the green part is the profit target. The last part is now where I should have had my take profit. Then the lower part here is my stop losses, and yeah. So guys, that's it for today. See you in the next session. It's your mentor signing out.